JPMorgan is aggressively standing for maximum physical delivery, from short and hope for lower to take it all in physical. A complete reversal. JPMorgan. 1 minute ago, not 6 months ago, not during a quiet accumulation window nobody was watching. Right now, on first notice day, in the most scrutinized silver delivery cycle in the history of this exchange. The largest bank on Wall Street, the same institution that spent 15 years as the dominant short seller in this market. The same institution that paid $920 million in 2020 to settle federal manipulation charges, just filed delivery notices to take 12 million ounces of physical silver into its own custody. And the question that every serious analyst is asking right now is not whether that happened. The CME report confirms it. The question is why. What does JPMorgan know that it is not saying publicly? What is it preparing for? And why is it doing this right now, at this specific moment, in this specific delivery cycle? The answer to those questions is what the next 7 minutes are going to give you. This is AG John OG, and before we go any further, I want to say something directly to every person watching this channel for the first time. What you are about to hear is not a price prediction. It is not a signal. It is not a course wrapped in analysis. This channel has never charged $1 for anything and never will. If this kind of financial warfare education, the kind that hands you the map before the destination becomes obvious, is what you have been looking for, subscribe right now. Because this community is built for exactly this moment. Let's go. January 7th, data revealed JPMorgan issuing 99% of 8.1 million ounces in delivery notices through 1,624 contracts. What made this unusual? January open interest increased by 1,431 contracts despite these deliveries. Investing.com. Read that sentence again. Open interest went up while deliveries were being processed. That does not happen in a normal market. When an entity takes physical delivery, open interest should fall. The contract is settled, the position is closed, the paper claim is converted to a bar of metal. But January saw both happen simultaneously. New contracts were being opened at the same time that JPMorgan was pulling metal off the exchange floor. That is the behavior of an institution that wants more silver than the visible market can supply without moving the price against itself. It is accumulation through delivery, the most direct, most documented, most irrefutable form of physical acquisition available in a regulated market. And it was happening while the paper price was being managed downward through margin hikes that cleared out the speculative long complex and gave the bank an opportunity to take delivery at prices it helped create. Estimates now put JPMorgan's physical silver stockpile at over 750 million ounces. Much of this was accumulated between 2012 and 2019 when silver was stuck between $14 and $20. So when I say they don't have the seats now due to their shorts, they are the 100-pound gorilla of the future. Kitco, 750 million ounces. At current prices approaching $90 per ounce, that physical stockpile is worth approximately $67 billion. Accumulated over more than a decade at an average acquisition price somewhere between $14 and $20 per ounce. The unrealized gain on that position, if the estimates are accurate, is measured in the tens of billions of dollars. And the bank is not selling. It is adding to it, right now, through the Comex delivery mechanism, on first notice day. Now let me show you what JPMorgan is preparing for, because the 12 million ounce delivery notice does not exist in isolation. It exists inside a structural reality that the bank's own research desk has been quietly documenting, while its trading desk has been quietly accumulating. JPMorgan's silver activity at Comex, and its delivery posture, is increasingly at the center of what is happening in this market. Physical silver accumulation by large institutional players has been going on for around 16 months now, with big money reportedly standing for delivery and taking metal at discounted prices, while margin hikes clear out the leveraged traders. Yahoo Finance. 16 months. Since November 2024. Every margin hike, every paper price crash, every forced liquidation event that destroyed retail and institutional leveraged longs, JPMorgan was on the other side of those trades, not as a neutral exchange participant, as a buyer, converting paper losses for others into physical gains for itself. February, controlled futures buying and standing for delivery, just enough to begin tightening spreads without triggering panic. March, accelerated covering across futures and OTC contracts, with expected volatility spikes and widening lease rates. Finance magnates. That schedule, February delivery, March acceleration, is exactly what the CME data is showing right now. The 12 million ounce delivery notice filed today is not the beginning of JPMorgan's accumulation. It is the February phase of a documented, sequenced strategy. And March acceleration means what it says. More volatility, more delivery stress, more lease rate spikes, and a bank that is structurally positioned to benefit from every single one of those conditions because it has already secured the physical inventory that the rest of the market is scrambling for. JPMorgan's shift from a massive short to a net long position marks a pivotal moment in silver's history. The bank now holds 750 million ounces of silver valued at over $40 billion and controls approximately 40% of Comex silver futures contracts. This level of institutional dominance is historically abnormal. Prior to 2025, no single entity typically held more than 10 to 15% of any major commodity futures market. Fortune: 40% of Comex silver futures contracts in the hands of one bank, the same bank that spent a decade as the dominant short. The reversal of that position, from the largest short in history to what is now reportedly the largest physical holder since the Hunt brothers, is not a trade. It is a strategic repositioning that takes years to execute and requires a very specific view of where this market is going. Now let me give you the counter-argument, because this channel exists to make you smarter, not to tell you what you want to hear. Verification of institutional positioning claims remains challenging due to reporting delays and market structure complexities. Investors should focus on observable data including exchange inventories, regulatory filings, and confirmed institutional announcements rather than unverified position reports. Kitco. That is the most important caution stated plainly. The 750 million ounce figure for JPMorgan's physical stockpile is an estimate derived from delivery reports, vault data, and custody filings, not a number the bank has confirmed publicly. The 12 million ounce delivery notice today is documented. The total accumulated position is an inference from visible data. The CME Group Rulebook under Rule 802 and Chapter 7 gives the board the absolute right to change margin requirements at any time without notice. On January 7, 2026, they raised the silver margin to $32,500, a 47% increase in a single week. Kitco. The exchange's kill switch has been pulled before. It will be pulled again if price action becomes disorderly. JPMorgan's accumulation position, whatever its true scale, exists inside a regulatory environment where the exchange can change the rules to protect systemic stability at any time. That is not a hypothetical risk. It is the documented reality of every prior silver stress episode. Thanksgiving night 2025, a silent delivery demand hit the system for 7,300 Comex silver contracts, 36.5 million ounces of physical silver. The problem, the entire Comex had only approximately 1.2 million ounces of registered readily deliverable silver in its vaults. Hours later, the CME's main data center in Aurora, Illinois, suffered a sudden cooling failure. Trading froze for 11 hours. The 36.5 million ounce delivery was quietly rolled to March. Luis Velasquez. Rolled to March. The delivery that almost broke the system on Thanksgiving night was not resolved. It was deferred. To March. To the contract whose first notice day just arrived. To the delivery window that JPMorgan just filed 12 million ounces of delivery notices into. The deferred crisis and the current crisis are the same crisis, separated by 90 days and a sequence of margin hikes that were supposed to reduce delivery pressure, but demonstrably did not. Here is what this all means taken together right now on February 28, 2026. Silver opened at $87.90 per ounce on February 27th and closed at $89.37. The gold-to-silver ratio stands at 57.6 with gold trading at $5,209.80. Comex silver inventory stands at 98 million ounces. Investing haven. During the first week of January alone, Comex registered inventory declined by 18 million ounces, while deliveries totaled 33.45 million ounces, meaning the balance was sourced from already allocated inventory or eligible stock conversions. The Street. For decades, global silver price discovery was firmly controlled by futures traders on the New York Comex. Trading volumes in paper silver dwarfed the total stock of above-ground silver. At one point, the notional ratio reached as high as 356 to 1. In other words, the amount of silver promised on paper far exceeded the metal that could ever be delivered. This system did not collapse only because of one simple assumption: nobody would ask for delivery all at once. In early 2026, that assumption failed. Golden Crest Metals. The assumption failed, And the institution that spent the longest time benefiting from that assumption, the bank that helped maintain the paper-to-physical fiction for more than a decade, has just filed delivery notices for 12 million ounces of physical silver on first notice day. JPMorgan is not betting that the assumption comes back. It is preparing for a world in which it never returns. And it is doing so by accumulating the one thing that cannot be created by printing paper: physical silver bars sitting in approved vaults under its direct control. The disparity between the BRICS silver price and Shanghai, currently at approximately $10 per ounce, is drawing metal out of the Western markets at a pace that is difficult to ignore and is increasing JPMorgan's silver holdings quietly in anticipation of what analysts believe might be a major repricing. Yahoo Finance. A major repricing, not of 20 or 30%, of the kind that happens when a structural assumption that has underwritten a market for 50 years stops being true. The paper-to-physical ratio reached 356 to 1. The registered vault has lost 75% of its inventory. The Shanghai premium is at $12. JPMorgan just took 12 million ounces off the floor on first notice day. The people who understand what that combination means are not waiting for CNBC to explain it. Before we close, your honest read, not the easy one. Do you think JPMorgan's 12 million ounce delivery notice today represents a bank that sees the structural repricing coming and is positioning ahead of it with physical metal it cannot get any other way at these prices? Or do you think the visible delivery data overstates the strategic intent and the bank is simply managing its vault operations and client custody in ways that look more directional than they are? The CME delivery report is public on the CME Group website and updates every business day. JPMorgan's registered vault holdings are reported in the CME Silver Stocks Report. The CFTC Commitment of Traders Report publishes every Friday at 3:30 p.m. Eastern. Every number in this video is verifiable from primary sources in under 10 minutes. The ones who verify will understand what the 12 million ounce delivery means before anyone explains it to them.